Welcome to The Explainer. Today we are tackling one of life's absolute biggest, most fiercely debated financial dilemmas, renting versus buying. For decades, we've all been fed a very specific narrative, right? We're constantly told that renting is basically just throwing your money out the window, and that buying a house is this ultimate, foolproof golden ticket to wealth. But when you actually sit down, crunch the numbers, strip away all the emotion, and really look at the raw data, the reality is far more complex. And honestly, it's a whole lot more interesting. Let's dive right into this and shatter some major real estate myths.
Here's our roadmap for today's explainer. 1. A tale of two lifestyles. 2. The hidden costs of owning. 3. The math behind renting. 4. The business case for renting. And 5. Making your ultimate choice. Let's get right to it. Section 1. A tale of two lifestyles. To really wrap our heads around this debate, we need to meet our two characters for today's explainer, Ryan and Steve. Now, they're both 32 years old, they live in the exact same city, and they both earn $80,000 a year. 3 years of aggressive saving, canceling all those streaming subscriptions, and literally convincing themselves that generic supermarket cereal tastes exactly like the expensive stuff, they have both managed to save exactly $90,000. So financially speaking, they are identical twins. But personality-wise, it is night and day. Ryan is totally driven by stability. He wants a place that feels permanently his. A garage for his tools and a backyard he can slowly become irrationally protective of. Steve, on the other hand, values flexibility. The very idea of a 30-year commitment to a single address makes him incredibly nervous. He wants zero anchors tying him down. Section 2. The hidden costs of owning. So Ryan decides to go for it and pursue his dream of stability. He buys a $439,000 house, taking his aggressively saved cash and sinking $87,800 of it into a standard 20% down payment. He's got the keys, he's got the yard, but he also just bought himself a massive, incredibly complex financial liability. Let's look at his actual monthly reality. Based on recent market data for a standard 30-year fixed mortgage at current rates, his principal and interest alone are $2,521. Add in a $45 HOA fee, $302 in property taxes, and $227 for homeowners insurance. Ryan is looking at a baseline of $3,095 out of pocket every single month. And even if we assume a future scenario where he manages to refinance down to a 4.5% rate, he's still locked into these high monthly administrative expenditures just to keep the lights on. But here's the thing. The mortgage is literally just the tip of the iceberg. Over a 30-year period, conservative estimates suggest maintenance costs will easily hit $50,000. We're talking about having to drop $15,000 out of absolutely nowhere on a new roof, or suddenly discovering that a slow, leaky faucet has caused severe foundational water damage. When you own the home, every single pipe, wire, and shingle is entirely your financial responsibility. And the costs don't just stop while you're living there. According to industry data from the Truehold blog, leaving your real estate investment comes with its own massive penalties. Selling a home is often the single largest transaction a person will ever make, and you literally have to pay a toll just to access your own equity. It's simply the cost of doing business. Boom. Imagine getting hit with a $22,000 bill. If Ryan eventually decides to sell his home for $400,000, with a standard 5.5% commission split between the listing and buyer's agents, $22,000 vanishes from his equity instantly. This is a massive hit to the return on his initial investment, and it's a number that so many buyers simply forget to calculate when they close on their house. And the hits just keep coming right at the finish line, because beyond those realtor commissions, Ryan is looking at closing costs that can easily exceed $5,000. Want the house to sell fast? Well, professional staging can run up to $600 per room. Appraisals and inspections average about $450 each. And if he hasn't lived there quite long enough, he might even get slapped with capital gains taxes of up to 37%. A major investment can easily be eaten away by these administrative hurdles if he isn't super careful. Section 3. The math behind renting. All right, let's pivot over to Steve. Remember, Steve values flexibility above all else. Instead of buying, he signs a lease for a totally comparable house in the exact same neighborhood for $2,620 a month, and that actually includes his renter's insurance. So what exactly happens to that $87,800 he didn't use on a down payment? Well, this brings us to a crucial concept utilized by tools like the quadratic financial calculator. Opportunity cost. It is the potential loss from a missed opportunity. Steve's entire financial strategy hinges on keeping his cash highly liquid and invested.
The math on this is honestly staggering, and it actually blew up recently on a Reddit real estate thread. If Steve takes that $87,800 down payment and simply invests it into an S&P 500 index fund for 30 years, at an average historical return rate of 9.82%, that liquid cash spectacularly balloons to over $1.45 million. That is incredible. While Ryan's capital is literally trapped in drywall, pipes, and shingles, Steve is putting his capital to work in the broader economy. So from a strictly mathematical perspective, Steve's liquid portfolio can vastly outperform the physical appreciation of Ryan's house.
Now, despite all this math, the emotional bias out there is just incredibly strong. Take a look at this direct quote from that same Reddit discussion. "I personally have never met a millionaire that rents." This captures a deeply ingrained societal myth perfectly. It's this common, totally understandable bias that homeownership is a strict prerequisite for building significant wealth, like it's a mandatory badge of financial maturity. But right beneath that comment was this absolutely perfect, snappy counter response from another user, "Multimillionaire here who rents." And the reality is, they're definitely not alone. In high-cost areas all over the world, there are plenty of very wealthy individuals who actively choose to rent. The math absolutely supports renting as a highly viable and sometimes even superior path to major wealth. Section 4. The business case for renting. Steve isn't just making some quirky personal choice here. Let's expand our lens from personal microfinance to macro-scale industry practices. I want you to ask yourself this. Why do major multi-billion-dollar construction and industrial companies often choose to rent heavy machinery instead of just buying it outright? According to market data on the equipment rental industry, renting is actually a massive global business, and it's driven by a very specific set of financial reasons. These massive companies rent to achieve what's known as capital release, meaning they do not want their cash tied up in depreciating immobile assets. They want to outsource the maintenance risk. When a rented bulldozer breaks down on site, the rental company comes and fixes it, not the contractor. They also demand operational flexibility so they can scale up or scale down instantly. Plus, they get to participate in a sustainable circular economy. These aren't just buzzwords, these are core tried and true business principles. And believe it or not, this is exactly the corporate logic Steve is applying to his own personal housing. Step 1, he keeps his capital liquid and invested in the market, essentially acting as his own capital release. Step 2, he pushes all the maintenance risk entirely onto his landlord. If the roof suddenly caves in, Steve isn't out $15,000. He just makes a quick phone call. And step 3, he retains total geographic flexibility. He can move for a better job tomorrow without paying $22,000 in realtor fees. Steve is fundamentally treating his housing like a highly efficient corporate balance sheet. Section 5. Making your ultimate choice. So where does all this leave us? Well, we've looked at the heavily hidden costs of homeownership, the powerful compounding math of investing, and the solid corporate logic of renting. Synthesizing all of this together, the truth is that the right choice is highly, highly dependent on your lifestyle, your time horizons, and your personal goals. This is exactly why utilizing analytical tools like the quadratic rent versus buy calculator is absolutely essential. Projecting your exact numbers out over 20 or 30 years transforms what is usually an entirely emotional real estate decision into a clear, data-backed financial analysis. Ultimately, whether you're a Ryan who just wants some roots and a garage for your tools, or a Steve who wants absolute freedom and strong stock market returns, you need to ask yourself one vital, truly provocative question before signing on any dotted line. Are you buying a home, or is the home buying you? Thank you so much for joining me for this explainer. Keep crunching those numbers and never stop questioning the narrative.